Welcome back, accounting boffins. Remember, we're dealing with assets. What did we say? Quick summary. When dealing with your assets, what do we take into consideration? The methods of depreciation. The two methods that we've dealt with is the cost price method and the diminishing balance method. The cost price method has other names attached to it: fixed installment, straight line method. All of them, you work with the cost price. Right. Then the other method of depreciation, diminishing balance, reducing balance, all of them, you work with the carrying value. So clearly you can see the two different ways of calculating your depreciation. Right. Okay. Now, I want you to, let's go through this in terms of the analysis of depreciation. So, when you're saying account debited, you're debiting depreciation. Why? Because it's an imputed expense, a debit to depreciation. You credit accumulated depreciation on vehicles. Why are we crediting accumulated? Because accumulated depreciation is what we refer to as a negative asset. What do we mean by that? By a negative asset, we mean it's that part of the asset that you have used up to date. Okay, in terms of my classification, obviously there's the amount, 3,600. Watch. A negative asset reduces the value of your asset. Therefore, accumulated depreciation will result in assets decreasing by 3,600, and your depreciation will result in your owner's equity decreasing by 3,600. Your liabilities remain unchanged. Okay, so now, watch. What are we saying? We're saying that depreciation is an expense. What type of an expense? An imputed expense, therefore debited. And you're crediting accumulated depreciation. The reason why you're crediting it, because it is a negative asset, right? Allow me to explain a negative asset one more time to you. A negative asset means every asset has two components. Original cost, which was 100,000, is the cost price. To date, accumulated depreciation, 60,000, that's the part of the asset that you've utilized already. So that's a negative asset. What's its carrying value? Cost price minus accumulated will give you carrying value. Okay, now the question says here, explain your classification for accumulated depreciation. What have we been talking about? Here we go. A negative asset shows a reduction in the value of an asset. For example, let's do it by ways of an example. Here's my cost price, 100,000. My accumulated depreciation is 60,000. Clearly you can see that you have a carrying value of 40,000. Why? What did we do? We took the cost price minus the accumulated depreciation to give me a carrying value. So now, a negative asset shows a reduction in the value of your asset. There you can see cost minus accumulated. Therefore, I'm repeating what I said earlier on. An asset has two parts to it. Its cost price, its original cost, and its accumulated depreciation, the total amount of depreciation that we have written off to date, therefore giving us the term negative asset. How does the diminishing balance method differ from the cost price method? Come, you should be screaming out the answer for this. Very simple. Your diminishing balance method, your depreciation is calculated on the carrying value or the book value, right? Whereas, and what is the carrying value? It is your cost price less your accumulated depreciation. You see that? So, what do we mean by the reducing balance method? We mean that you're taking your cost price minus your accumulated depreciation. Let's show it to you. Cost price minus accumulated depreciation is equal to my carrying value. So how does it differ from the cost price method? On the cost price method, you only calculate depreciation on the cost. You don't take into account the accumulated depreciation. What happens to the amount of depreciation each year when the diminishing balance method is used? Think about it. But before you think about it, let me give you another example, just to set your mind at ease. Let me show you what we call, let's make this 5, 10, let's say year 1, year 2, year 3, year 4. Okay, now if we're saying that we're using the straight line method or the cost price method or the fixed installment method. In year 1, you're writing off 10,000. In year 2, you're writing off 10,000. In year 3, you're writing off 10,000. In year 4, you're writing off 10,000. What graph do you get? Clearly, you can see a straight line. And definitely, Ashraf is not doing maths, we're doing accounting. But I want you to understand that the straight line method shows you that your depreciation is fixed every year. Right. Now, what happens to the amount of depreciation when we are using the diminishing balance method? Watch. It is decreasing progressively. You'll notice, again, if we have to illustrate by means of a graph, if you started off there, the next one is going to go down, you're going to come down, 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 and in that way you're going to see it's going to be a diminishing balance. As the years go, the depreciation will decrease, and therefore it's called the diminishing balance method. Why will you not consider changing the methods from year to year? I mean, come on, this year we use cost price, next year we use diminishing balance, and then we revert back to cost price. Can we do that? The answer is no. The method remains consistent, reasonable. You must be able to do a comparison. There must be a reasonable comparison from one year to the next year. Obviously, it's open to abuse. And if you want to just keep on changing it, then obviously that is not in line with international financial reporting standards. When it comes to internal controls, and this is very, very important, accounting controls a wide range of controls which will include, amongst others, double entry bookkeeping to ensure that we've made the double entries in terms of debit and credit, right? We look at budgetary control. Remember, in our previous lessons, when we dealt with budgets, we said we're drawing up a budget as a forecasting tool. Now here also, the question you may be asking, how does a budget tie in with our assets? If you've done your budgeting correctly and you've noticed that one or two of your assets are coming to the end of their useful lives, it would now mean time to buy new assets. So obviously you need to budget for it. Periodic operating reports and statements, financial statements, cash flow statements, balance sheets, also called, remember the new terminology that we're using, your statement of financial position, statistical analysis, internal control. All of internal control means what? To safeguard the assets of a business. Got that? Again, internal control to safeguard the assets of a business. A sound internal control system should observe the following general principles, right? Now we're giving you general principles. Anything to dealing with internal control should take into account: 1, division of duties. We've explained this in many other sections of our work, and this is why it's important for you to see that internal control can be examined, can be asked for in different aspects of the work in accounting. So don't limit it to just one section of the work. With regards to assets, proper division of duties, meaning the person that's responsible for purchasing the assets cannot be the person that's responsible for ordering it. Yes, one person will order, somebody else will receive, somebody else will authorize. What are we doing? We're dividing the duties. Why? So the one serves as a check on the other to avoid fraud. Proper authorizing. You can't just nilly-willy decide we're going to buy a new asset worth 2 million rand. Obviously, it needs to be authorized. It needs to be go through the process, the entire procurement process, which is so currently we can see it happening in our country, that there has to be proper authorizing. So the person who finally signs off has to have the authority and must have done the checks and balances to ensure that we actually need that particular asset, and obviously that we're procuring it at the best possible price. Documentation, very, very important. There has to be documentation for the asset in terms of the order copy, the final figure that will have to be paid for it, the invoice, etc., the terms, etc. Proper recording and follow up, the purchase, the sale, the depreciation, and obviously the resale or the disposal of the asset, of the old asset if necessary. So you can see, guys, there has to be proper internal control processes in place. Fixed assets are part of the financial assets of the business, and the business should keep proper records of all its fixed assets. Remember, we spoke about it earlier on. Let me mention it again. And what am I talking about here? I'm talking about the fixed assets register. Okay, now, if you look at a ledger account, right, here we go, just a rough T account, and I'm telling you, you've got assets worth 20 million rand. Okay? Do you know, does the ledger account tell you what assets you have valued at 20 million rand? If this is your, for example, your vehicles account. Where are you going to get the information regarding the 20 million rand worth of vehicles? In your fixed asset register. Every vehicle will have a register with all its information regarding that particular vehicle. In that way, we are able to control what? The records of that vehicle in terms of when was it purchased, who was the supplier, what was the purchase price, what's the method of depreciation, etc., etc., etc. So all the information regarding that vehicle will be in it. So, like you have a register in school for your learners and your educators, by the same way, you will have a register of fixed assets, which will then be used as part of your internal control processes. It means if you're looking at an asset and you're saying, okay, this particular asset has reached the end of its useful life, how would you know that? You'd look at the fixed asset register, look at its original cost, look at its residual. Have we reached the 1 rand? Yes, we have. And that way, we will now be able to do the necessary. An effective system should include the owners must authorize all purchases and disposal of fixed assets and record them in the fixed assets register. Safeguard fixed assets against theft and losses. Very important. An effective system should include the following: keep purchase orders, contracts, lease agreements in a safe place. Record any update of fixed assets in the assets register with regards to depreciation, acquisition, disposal of assets that need to be disposed of, right? So you can clearly see you're updating your records, and all of this is part of internal control. Make sure that there's no theft, corruption, mismanagement, poor record keeping. Make sure that both, and obviously guys, this happens in both private and the public sector in South Africa. And not only in South Africa, but in the world over. You find this in the media on a continuous basis, where there's a talk of corruption and whatever else it goes with it. So yes, accounting is there to safeguard the assets of a business. With regards to ethics, it also to do with we have to do what is right and stay away from what is wrong. It is a code of behavior that protects the rights of individuals. Do what is right. What are the characteristics of ethics? Accountability, discipline, fairness, independence, respect, and responsibility. Think about your own life. In order to lead an ethical life, you need to have these characteristics in your life as well. So this applies to the accounting part of ethics as well. Remember what else? Transparency, integrity, confidentiality, and obviously operating standards of behavior. So taking all of this into consideration, guys, you can clearly see how all of this ties in with our topic, which is fixed assets. Right? So I think we've done quite a bit in today's lesson, and I'm sure you're now very excited about assets because you understand it better. And also now, when it comes to asset disposal, I'm sure you'll be able to see why we're disposing of an asset. It will actually make sense to you why we do an asset disposal. Until the next time, guys, keep your feet on the ground. Keep on practicing your accounting because you want to be an accounting ace. Definitely, you are going to be an accounting star. Until the next time, be good.